Hello everyone. Welcome to another lecture of our IFRS 13 series. Today, we will explore into an important aspect of fair value measurement, that is the markets. We will explore the concept of principal market and the most advantageous market and understand how these influence the determination of fair value. This session will clarify which market price we should refer to when calculating fair value. So let's begin and understand the concept of market. We know fair value is closely tied to the market. But what does IFRS 13 mean by market? Is it the local market, national market, or an international market? And which specific market you should refer when determining the fair value? IFRS 13 gives us clear guidance on this. The first type of market you should consider is the principal market. The principal market is the one with the highest volume and level of activity for the asset or liability. It is the market where the most transaction for that particular item occur. This makes sense because a market with more transaction is likely to provide a more accurate reflection of asset or liabilities fair value. But what if there is not a clear principal market, or if the principal market is not accessible? In that case, IFRS 13 tells us to use the most advantageous market. This is the market where you get the best possible price after considering transaction cost and the other relevant factors. Let's dive deeper into the concept of principal market and the most advantageous market, as these are crucial when determining fair value under IFRS 13. Principal market. Principal market is defined as the market where the highest volume and the level of activity for the asset or liability occurs. This is the first market you should consider when determining the fair value. The logic behind this is straightforward. When most transactions for a particular asset or liability happens in a specific market, that market is likely to provide the most reliable and the accurate information about its fair value. Let me give you an example to make this concept clearer. Suppose you are a farmer with a large quantity of wheat to sell. The principal market for wheat might be a major agriculture commodities exchange like the Chicago Board of Trade, where the highest volume of trading occurs. This market has the greatest level of activity and provides prices that are generally accepted as reflecting the true market value of wheat. So the principal market, due to its activity level, will give you the most accurate reflection of what your asset or liability is worth. But here, a question arises that what if the principal market is not accessible or does not exist for your specific situation? Like in our example, accessing Chicago Board of Trade might require you to meet certain quality standards, bulk quantities, or incur significant cost to transport your wheat to the market location. That's where the concept of most advantageous market comes into play. The most advantageous market is the one where the entity would receive the maximum net proceeds after considering all relevant costs, such as transaction cost and the transportation cost. In the context of IFRS 13, if you cannot identify or access the principal market, you should then determine fair value based on the most advantageous market. In financial terms, if a company is selling a product in multiple regions like Asia, Africa, or Europe, and there is not a dominant market where the most transaction take place. They would look at the market which offers the best net returns. This is done by taking the fair value in each market and deducting the transaction cost and the transportation cost. The market that provides the highest net return is considered the most advantageous market. Now, to determine the most advantageous market, you reduce all logical costs such as transaction and transportation cost in order to identify which market yields the highest net proceeds. However, when calculating the fair value itself, you only deduct the transportation cost from the selling price, not the transaction cost. Sir, we are getting confused between the transportation cost and the transaction cost. Okay, let me first explain you what is transaction cost and what is transportation cost and how they come into play when determining fair value under IFRS 13. Transaction costs are costs directly related to selling an asset or transferring a liability, like brokerage fees, legal expenses. Under IFRS 13, when determining fair value, you do not deduct transaction cost from the market price. These costs are considered separate from the fair value measurement. Note that fair value is not net realizable value. Fair value is not fair value less cost of disposal. And using the price at which an asset can be sold for as the basis for fair valuation does not mean that entity intends to sell it. The transaction costs are not deducted unless specifically required by the relevant accounting standard. This is crucial distinction to remember, especially in exam situations where you might be asked to calculate the fair value. For example, IS2 inventories. The net realizable value or NRV is calculated as the estimated selling price minus the cost to complete and the cost to sell. Similarly, IS41 agriculture might include transaction cost in their fair value consideration, but IFRS 9 financial instrument, IS16 property plant and equipment, and IS40 investment property generally do not. On the other hand, transportation costs are the expenses incurred to move the asset from its current location to the market where it would be sold. If the asset's location is a key characteristics, then the market price should be adjusted for the transportation cost necessary to bring the asset to the market. Let me explain you all this with an example. Suppose an entity holds an asset which could be sold in one of the two markets. Information about these markets and the cost that would be incurred if a sale were to be made is as follows. Now, let's say market A is the principal market for the asset. In that case, fair value of the asset would be measured using the sale price that would be received in that market after taking into account the transportation cost. So $240 would be the fair value. That is sale price of $260 minus transportation cost of $20. Now, let's say neither market A nor market B is the principal market for the asset. In that case, the fair value of the asset would be measured using the price in the most advantageous market. The most advantageous market is the market that maximizes the amount that would be received to sell the asset after taking into account the transaction cost and the transportation cost, that is the net amount that would be received in the respective markets. Therefore, in our example, most advantageous market is market B, because the net amount that would be received for the asset would be $220, that is sale price of $250 minus transportation cost of $20 and minus transaction cost of $10. But the fair value of the asset is measured using the price in that market, that is $250 less transportation cost of $20 only, resulting in the fair value measurement of $230. So, while determining the most advantageous market, reduce both transaction cost and transportation cost. However, once market is determined, do not exclude transaction cost in your fair value calculation. Only deduct the transportation cost. In summary, the most advantageous market is used when there is no clear principal market, and it is determined by comparing the net proceeds after considering all relevant costs. But always be mindful of the difference between determining the market and calculating the fair value itself. Transaction costs are only deducted if required by the relevant accounting standard, while transportation costs are typically deducted to reflect the true market value. In this lecture, we have explored the difference between the principal market and the most advantageous market, and how each play a role in determining the fair value. Understanding which market to refer is crucial for accurate fair value measurement. In our next session, we will discuss who the market participants are and why their perspective is vital in fair value assessment. Thank you for your attention today, and I look forward to our next discussion.